How are you?
Hi, Pamela. I am well, and it's great to be here as always.
Lovely to have you here and to have you join us. We'll invite everyone to send their questions in. We're doing a bit of a deep dive into the consumer here itself. So discretionary and staples, but let's go to what the data itself seems to sort of be blow the doors off the barn data. I mean, is there any reason not to get into discretionary at this point?
Yeah, well, discretionary, at least in the S&P 500, has underperformed over the course of the last year. The interesting part about it, down the cap spectrum, the further down the cap spectrum you go, even to the Russell 3000, you will all of a sudden change the equation, meaning consumer discretionary hasn't been leadership, but it has been an outperformer. And I do think that the risk reward has been positive. Interestingly enough, it has been a good setup for the US consumer from an economic perspective, and it has been a good setup for the discretionary sector from an earnings perspective. All of what we've seen, either over the last year in the S&P 500 or over the last couple of years in as you go down the cap spectrum, has really been multiple depreciation or multiple contraction, which I think actually sets you up as an investor for a much better risk reward going forward. So I do think that we are entering the phase as we go through into 2025, where the backdrop for the US consumer from an economic perspective is quite positive, and the valuation support across the board is positive for the equities as well.
You always say where you start matters. And this is obviously from a very low point that this start perhaps of this begins. Bring in the story of feeling confident about the job story. And I know in 24 hours there's going to be non-farm payrolls, and there's not much we can do about knowing whether that number is going to be where it's going to be because we just don't know. But that said, the confidence in jobs as you invest in consumer stocks, where do you place that confidence? Pretty high?
Yes, it's interesting. So we have seen a little bit of a rebound in confidence, and I think that that's taken some people slightly aback. And I'll talk about it specifically as it relates to the Philly Fed. That's a great survey that I watch. If you're thinking about Denise, what data do you watch? That's one of them. So the Philly Fed intentions survey, I think goes back to 1968, and we have seen intentions to hire actually pop quite a bit over the last 6 months. And as surprising as that might seem, it actually often happens when the Fed is cutting rates. So we actually came to what I would call no churn in jobs, which we've talked before. There's no hiring, but there's also no firing. There is nothing of anything. There's not a lot of movement in the job market. The question is, as we go forward, should we expect a rebound or should we expect just continued deterioration? And I think a lot of data points are still pointing towards a rebound. We still do have strong profitability, which again, we don't know what non-farm payrolls are going to be. But if you back up what leads payrolls over time, profitability in corporate America. If corporate America makes money, they tend not to fire you. Data point number two is we just saw a massive revision in income at the same time as we saw a massive revision down in payrolls. Those two things usually go together 80% of the time. And when you look at when income is accelerating and payrolls are decelerating, that resolution is usually around the fact that it was just a soft patch in payrolls, that actually it was the pause that refreshes, that actually rebounds to join income in terms of growth. And now we're also seeing this rebound in the Philly Fed intentions of hiring, which is typically what you see after interest rate cuts. Again, I think the story ties together that the job market, which is critical to the durability of the economic cycle and is critical to the consumer, is still in pretty good shape.
And with that sort of wages and margins, well, the wages story within what you're saying of the job story, is that you often talk about this, the absorption mechanism that I think has corollaries in other sectors as well. I think you've mentioned it also in real estate, in all kinds, even in oil. I mean, there with wages higher, we seem to be able to absorb various different things. Is there a corollary that you might point out here?
Yeah, so you can grow into a lot over time. That relates to multiples. So our starting point on the S&P 500, does it matter as much? When you look at 1 year odds in terms of what your starting point on multiples the S&P 500 does to your go forward odds of a market advance, they're all the same from cheap to expensive in terms of quartiles. So it shows you that the starting point on multiples might matter if you hold everything else constant, But to the extent that earnings growth is positive and durable, you can grow into those multiples over time. So I think that that growth in the economic cycle, again, if jobs are growing, incomes are growing. And if incomes are growing for the US consumer, that can offset just a ton of these headwinds that we want to microanalyze, like tax increases, like, did oil go up, $10 a barrel? Did interest rates just go up, for 40 basis points? All of those little headwinds can get absolutely dwarfed by income growth from cycle to cycle, which is why that durability focus of the probability analysis I do is so critical, because durable earnings growth and economic cycles produce very, very good results for the equity market and for cyclical sectors or economically sensitive sectors like consumer discretionary over time.
So just extend that into what the market perhaps is pricing or isn't pricing for tomorrow, but really to the Fed, what the data will be for the Fed to have to perhaps maybe not make a decision on, but certainly incorporate into its decision on the jobs front.
It is tough because the Fed has said many times that they're very data driven. And so they lead you to believe that they are very focused on these month-to-month data points. Payrolls are a problem right now to focus on month-to-month. They're generally a problem focusing on month-to-month, but specifically around the strikes and hurricanes we've saw. We've seen some Fed speakers say, well, it probably quantifies to about 100,000, so maybe we should add that to think about what the sustainable trend is, X that shock. But really, there's a lot of variability on a month-to-month equation. So it's not just payroll growth. I think that the Fed really is focusing on as much as they talk about it, so that the market sort of incorporates that into market views. But I mean, even when you think back historically speaking, when you look at pre-revised numbers for non-farm payrolls, the average number of months you went in the 90s between, negative payroll print to negative payroll print was only 20 months. Ours has been 43. And again, you won't see this in the already revised data. You'll see no, negative payroll numbers. But usually because payrolls are heavily revised, you do have a down print. So I don't think that you can ever rule that out. I also don't think that that would be indicative of anything as it relates to the strength in the labor market. Again, we've seen the labor market slow down. I think that the labor market is likely to pick up, but as this relates to the Fed, the growth rate is less important than the inflationary dynamics behind it. And that's really important. It's the nuance of the labor market that the Fed is very focused on. And that labor supply demand mix determines inflation, and that determines in some ways their policy rate. So the mix of what growth looks like and the inflationary impulse behind it is going to matter more to the Fed from an inflation perspective than I think the number itself.
So can I dig into that growth piece that you're talking about there? Is this growth of jobs and also whether there's a wage expansion there? I mean, give us a bit more on the growth that would be maybe a concern to the Fed.
Right. So I get a lot of questions from investors that say, well, look, payroll growth has now slowed to a stall speed and it's decelerating. The next, we should linearly extrapolate that out and we should expect a contraction in payrolls because payroll growth is so weak. If it picks up, Denise, then we're in a different situation where if it picks up, then inflation picks up. And either way, we have a problem in the stock market with either low growth, or if you have better growth, then you have inflation that the Fed now has to deal with. And I actually think that that's false logic historically. When you look at payroll growth, year-on-year payroll growth, you would think that it might correlate to either inflation from a CPI perspective or inflation from an average hourly earnings perspective. It does neither. Only 50% of the time when you see payroll growth accelerate, right? So now jobs are growing 1.7. Let's just say Denise gets it right. And over the next 12 months accelerates to 2.5, right? Is that 1.7 to 2.5? Is that acceleration trend usually correlated with inflationary impulse? Either CPI accelerating or average hourly earnings accelerating? Only half the time.
Really? Okay. I was really leaning in there. I was like, wait. I'm on the edge of my. Okay. Really?
Right. Only half the time. So again, it's like that Princess Bride quote. I don't think that data means what you think it means. And part of it is there's probability bleed, right? In the sense that payrolls are just one measure of jobs in the market, right? I mean, they're not the perfect measure, as are average hourly earnings or even the ECI or anything else. These are all imperfect measures. So in some ways, we shouldn't necessarily expect them to go together, but there really is very little correlation because not all growth is inflationary. The nuance behind it really matters. And by the nuance behind it, I mean the rebalancing in the labor market. So you can take a data set and bifurcate those odds and give it meaning. So the growth, when payroll growth accelerates and job openings are accelerating as well or headed higher, that tends to be a situation where overall inflation accelerates and average hourly earnings accelerates. That's not our situation, right? We are in a situation where job openings are declining and re-normalizing from that post-pandemic extravaganza in some ways of job openings and the great, I think Barry Knapp calls it the great labor reallocation when everybody changed jobs. And that situation is still re-normalizing. That tends to be a disinflationary impulse regardless of your growth rate. So I do think that a lot of history backs up the fact that even if we see payroll growth rebound, it's not likely to be inflationary and not likely to be a problem for the Fed.
I'm gonna have to ask you at the end of this broadcast which character you are from The Princess Bride, but we'll get there. We'll get there. So with that, and that it's only 50% of the time that it will impact inflation, as in make it go up, on the jobs front, what do equity investors need to know? I think you've worded this before, need to know that they don't know. Like what do they need to sort of allow it to be all else equal?
Yes, so growth matters more than inflation. I mean, when you want to sort of break it down, is to remember we're all focused on what the Fed will do, what will interest rates do. Denise, make it make sense that interest rates are going up and the equity market has actually gone up as well, because the why behind interest rates matters much more to the equity market than rates itself, right? Always remember that. Growth is the first order principle for equity market investing. Growth trumps rates.
So GDP, so GDP came out, it was revised, looked healthy, looks within, I mean, sort of the 3%, 2% is closer to 3%, but fine. Okay, there's the growth that we're sitting at right now that we know about. Again, Fed need to move.
Right. Right. So again, I think the Fed has two targets, right? So the Fed has a full employment target and the Fed has an inflation target. So inflation, as we just talked about, is not always related to growth. So you could consistently see, and I think the Federal Reserve is seeing, a disinflationary impulse. Inflation is decelerating, even though growth is strong. So then the question becomes to the Fed, remember, it's not just about cuts and hikes, it's about where you are, right? So starting points absolutely matter. Would the Fed need to cut if their starting point was 3? No, it wouldn't, because that's in line with growth. But does the Fed need to cut if their starting point is 5? That's, I think, what investors are always forgetting, is that the starting point matters and the Fed is too restrictive based on where inflation is decelerating to, even despite what growth is. And I think that we're going to see this play out over the course of the cycle, despite the fact that investors keep getting very, very focused on the minute data points that suggest cut or hike.
Right.
I think that there's opportunity in that.
That's so interesting. So do you think, it sounds like you don't think that the consumer perhaps maybe is aware of or listens to the growth story enough? Because consumer sentiment 2 or 3 months ago was, I mean, it was a depressing place to look. Everyone was just totally long faces about it all. Right. And here we are. Have they not listened to the growth story enough?
Well, it's still low. I mean, even though we've seen, I talked about a little bit of a bump in consumer expectations. We just saw it, and you would say that it's still low. And look, I think that this cycle was very, very different from anything that we've seen play out in history. So remember, when you go back to the 70s and 80s, we did in fact have a wage price spiral. So much so that when the economy was not in contraction, meaning when you kept your job, your wages kept pace with inflation and mostly outgrew it. So there was no, as much as we measure like inflation and unemployment being that misery index, if there wasn't unemployment, and even if there was inflation, there was less misery than you would expect because your wages were keeping pace. Our, what I'm going to call our quasi recession in 2022, which wasn't an official recession because nobody lost their jobs, was the deepest contraction in real wage growth ever for people who kept their jobs. This was a very unique cycle. So the US consumer did the right thing in the sense that I kept my job, check. I went to work every day or half the time or however often the consumer went, check. And I still lost a massive amount of purchasing power, 20%. Right? Prices are growing more slowly, but they're not declining. Right? So you'll never get back to those 2019 levels. I don't want to say never. I hope actually we never get back there because that much deflation is a big problem for equity market investors. But what you see is the hangover of the first time that the US consumer was impacted in that way. So yes, people are still angry, people are still upset by inflation. The only way to solve that is how we are seeing it solved right now, which is finally real income growth is positive. My suggestion is that it's durable and you will grow into that inflation that you saw or that, contraction in real income that you saw in 2022 over time. But it's going to take time and it's going to take the durability of income growth to come through to see more durably confident consumers.
I won't ask you about this, but just as sort of an example, in the Bank of Canada, some of their targets that they put out last week, some seem to be well received and some are not. But one of the things that was noted was a bit of a surprise was that the savings rate was actually higher. So not the same as the hangover that you're talking about there, but Canadians knowing that mortgage renewals are coming up and have known this for a couple of years, have been putting it away to get ready for. I'm just wondering if there's something similar to the US where, okay, they went through that in 2022, as you mentioned. Was there an effect of squirreling it away, meaning a higher savings rate, which means it could be deployed? What does it look like?
Yes, we're already seeing that. So, I mean, the funny thing was what you probably heard from a lot of strategists over the last 3 years is the consumer's running out of cash, right? And
Yeah.
they were measuring the savings rate. I think it was as low as 2 and change percent. And it turns out, I mean, the savings rate is literally the most heavily revised data set the US government releases. And that 2% turned out to be 5 and change. I think it's not quite 5.5. I think it's just below 5.5. And that's what we know now. So Doug Lee, which was an economist that I followed for many, many years, he always used to tell me, Denise, remember that the government always finds income after the fact. It's very hard to calculate all the income real time. And so we always find more of it in those final revisions 3 years down the road. So yes, your point is very well taken, is that while we thought based on the data that the consumer might have been running out of cash, turns out they were, in fact, squirreling it away, which puts them in a much better situation than we thought that they were in.
Because at least it's there, which
Right.
is yeah, there's lots of comparisons there. Really, really interesting. So let's get into the sectors themselves. You've mentioned off the top consumer discretionary, of course. Some of those stocks it's been rough for them for all of the reasons that you pointed out right now. Take us through some of the other sectors, even when we're looking at the consumer, perhaps it impacts in other places.
Yeah, the interest rate sensitive sectors still are the most intriguing for me, financials and real estate specifically. And I view them in some ways jointly, but they are very different and they do have, in some ways, different drivers. Where financials reminds me very much of consumer discretionary in that earnings growth has been quite strong. But what you have seen is, again, this multiple depreciation back to levels. We're not quite under 10 times for a sector basis on an absolute level, but we're also not far from those levels either. And I do think provides a really, really strong risk reward opportunity. So when you have seen a situation where earnings growth is strong and you have valuation support, again, I always measure valuation support. And do I see a linear correlation? The cheaper stocks have been historically, the more likely they are to advance. Yes, I see that in financials. If you couple that with strong earnings growth, it usually provides you above 70% odds of future outperformance. So I do think financials are a very interesting space. I would call out specifically capital markets and brokers for those that are less interested in banking exposure, which is obviously more tied to regulations, regulatory risk. Although when I look at the financial sector overall, if you say, okay, let's segment it into those that have a lot of risk that I might want to avoid those are the areas of the market that have the widest valuation spreads and the cheapest valuation. So it's hard for me not to think that a lot of that downside is already priced in, given those statistical historical relationship. And then the areas of the market that have strong fundamentals, I still think are mispriced relative to the rest of the market. But so there is that bifurcation of banks, obviously, that have that regulatory backdrop. I think are a positive risk reward based on what's priced in. But then there's also a lot of fundamental sectors like brokers and capital markets that have strong fundamental trends from a secular perspective that I still think have a positive risk reward. So I think it's across the spectrum just for different reasons. And real estate intrigues me from the court, like fundamentals are quite poor. You wouldn't say fundamentals have been strong in real estate. They're quite poor, which usually means that by that point, the stocks have likely priced in the downside. That's confirmed with its own wide valuation spreads. And what you see is historically, there's a fairly linear relationship between the more fear there is and the worse fundamentals are, the more the sector becomes a pain trade. Now you have the catalyst of interest rate declines or the Fed cutting rates. And historically speaking, when you see the Fed cutting rates coupled with these oil price declines that we've seen, the number one sector to own has historically been real estate because it's both economically sensitive and it is interest rate sensitive. And I think that that's the backdrop that really changes the risk reward as we go through 2025.
Do all three of these sectors, so consumers on kind of both sides of consumer discretionary staples,
Mhm.
maybe it's more discretionary, financial and real estate in the areas that you're looking, do they have that sort of, have they hit support essentially in terms of the valuations? Like if everything's priced in, are they kind of sitting on top of that support at this point? There's some confidence.
Right. It does look like that, right? Again, I look at it in those relationships. Do you see the cheaper stocks are, the more likely to outperform? I can't give you any guarantees, but usually that's what I base my risk reward odds are. So you're seeing it certainly in financials, a little less so in real estate. It starts to depend on how you measure it based on fundamentals, but you are starting to see it in a lot of my valuation measures on real estate as well. And then consumer discretionary is really intriguing to me because, again, on the valuation measure that matters the most from a cap weighted perspective, it's free cash flow. And because of the very, very strong, again, only cap weighted free cash flow generation, you've seen one of the biggest multiple contractions in history back to certainly bottom quartile, if not bottom decile levels for this space. So while earnings have been growing and free cash flow has been growing, this sort of either underperformance or mild outperformance, the headwind that you have seen from that multiple contraction has been enormous. So the question becomes, is that headwind likely to continue? I would bet not, based on those fundamentals. And if fundamentals stay strong and you have this valuation support, that usually puts you in a situation from a sector perspective where now you have dual tailwinds. You have the tailwind of possible multiple appreciation and the tailwind of earnings growth on a relative basis. So I really do think that consumer discretionary is in a much better position than it was a year ago, even though I thought that the risk reward was positive. I think that the risk reward is even more positive because of that potential for that dual tailwind.
With looking at that so positively and having some confidence, looking at it, does that help allow you to go down cap to look at
Yes.
smaller consumer discretionary companies?
Yes, without a doubt. I mean, I think that you have already seen relative price to book be bottom quartile and bottom decile for the last year in the equal weighted space. You now have a catalyst in interest rate reductions that have 70% odds historically when interest rates are going down and earnings are accelerating. Small caps overall tend to outperform. And I think that that's even more true in the area of consumer discretionary itself.
So you're just looking at the benchmarks as well that you're going to be looking at this. When we look at I mean, just a couple comments on small caps, broadly speaking. This is where a strong consumer certainly could go to work and could really make a meaningful difference for those looking at smaller companies. Is that across the boards? Maybe
But it does look across the board, yes, in my work.
Perfect. That's amazing. Are we sort of, I guess we have to ask about the election and where all of this ultimately matters over the next 5 days, only 3 business days and so on until the election. Do investors, it seems to be the inclination is to sit and to wait. These are longer term trends that you're talking about, but there is sort of this inclination to sit and wait. How do you talk investors through that?
Well, it's tricky, right? So we talked about last time, like I know that because it's very uncertain, investors tend to want to sit on the sidelines and wait for certainty. When I look through the data that way, that seems like the riskier proposition to me because the higher the starting point on uncertainty, the more likely the equity market is to advance. Remember, there's two things. There can be a shock that's a systemic shock that tips us into a recession, or it could be a shock that you thought was a shock where we climb the wall of worry. That's what we've seen play out over the last 3 years. And I think that we are likely to see that continue to play out because valuation spreads still are so wide. By that measure, for me, there is still a lot of fear in the equity market. So whatever it is that you're afraid of, and insert election, geopolitics, interest rates, inflation, the odds are when I look at the data are increasing that it might be priced in. So I always caution investors that are investing based on the election or based on the results of the election to really think about what the long-term dynamics of the equity market are. And it's not who gets into office, and it's not even sometimes the policies that result from that. It is more often than not income growth, earnings growth, which are exactly the things that we were talking about, and the durability of those two factors.
You can't trade the election. I mean, you could, but
I'm not going to.
Or not going
You can if you want to.
don't be prescriptive, but yes, your
Right.
thoughts on
Right.
that.
Right.
Denise,
I wouldn't. Right.
you wouldn't. Great to see you. Thank you. We'll see you after the election and
Yes.
wish you very well.
Great to be here. Thank you.